In this presentation, we're going to focus on my newest book, Higher Probability Commodity Trading, a comprehensive guide to commodity market analysis, strategy development, and risk management techniques aimed at favorably shifting the odds of success. We will merely be scratching the surface, obviously, but the idea is I want to give you a couple of ideas and concepts that not only will help you with your trading, but will also give you an idea of what this book is all about. This book covers the gamut. You know, we touch on a lot of basic commodity knowledge and information and go all the way up to some extremely, well, I shouldn't say extremely, but some rather complex strategies, selling options, covered calls, that sort of thing. If you don't know who I am, my name is Carley Garner. I am a commodity broker with Carley Trading. We're located in Las Vegas, Nevada. If you ever have any questions about trading commodities, this book, or anything in general, I guess, feel free to give me a call. Here's my phone number and my email address, cgarner@decarleytrading.com. If you're on social media, check us out on Facebook. You can either search my name or search DeCarley Trading and you'll find us. My Twitter handle is @CarleyGarner. And we're also on Instagram. Before we get started, I want to make sure that everybody understands there is a substantial risk of loss in trading futures and options. Trading is not suitable for everybody. Commodity trading gets a bad rap. A lot of people have heard horror stories of, you know, somebody losing their shirt or even losing their house. The reality is the commodity markets can really be anything that you want them to be. They can be as risky or as conservative as you want them to be. That said, it's still not necessarily, you know, we're not collecting dividends and interest here. We're trying to beat the markets. It's speculation, and it's not necessarily easy. First topic we're going to talk about is trend trading. We're actually going to discuss a few of the advantages and disadvantages of trend trading, and then we're going to do the same with swing trading. You'll find that in this presentation and in my book, I give a lot of basic ideas and opinions. That doesn't mean that my opinion has to be your opinion. The one thing I want everybody to walk away from this presentation and this book with is the idea that there really is no right or wrong way to trade. Everybody has a different personality. Everybody has a different set of strengths and weaknesses when it comes to emotions and gathering knowledge and decision making, and most importantly, not everybody's trading the same size of a trading account, and trust me, it makes a huge difference. How well you're capitalized is really one of the deciding factors on whether or not you make money. So as you're deciding which strategy is best for you, you really want to keep those things in mind. A common assumption is that the highest probability method of trading is trend trading. If I had $1 for every time I've heard the statement, you know, why don't we just identify the trend and jump on for the ride, I'd probably be a rich woman. The reality is it's not that easy. You know, people assume that they put together a little trend trading system, whether it's moving average crossovers or maybe just the MACD in general. You know, but the idea is the trend is not always your friend, and sometimes it is, but not always. And even more specifically, the trend really is only the friends, or is only friendly to those with really deep pockets. So is it as easy as just identifying the trend and jumping along for the ride? Absolutely not. Trend traders face lower win percentages and bigger losses. This is just the reality of trend trading. Some of you might be surprised to hear that because, again, you think the trend is your friend, but I would venture to say, now keep in mind this is a general blanket statement. There are different types of trend trading methods. Some are quicker than others, some are slower than others, but the general scope of trend trading would involve roughly 25 to 30% win percentage, meaning you're going to lose probably 70 or 80% of the trades. So why the heck would you trend trade? Well, the reason being, when a trend trade does work, the winners can be massive. Trend trading is also really popular because it's comfortable. I mean, we're all humans, right? What's comfortable is buying as the market's going up and selling as the market's going down. But just because it's comfortable doesn't necessarily mean it's always the right thing, and it doesn't mean it's the right thing for everybody. In fact, most traders lose trading commodities. I wish I didn't have to say that, but I do. It's just how it is. It's a zero-sum game. For every winner, there's a loser, but in the end, there's going to be more losers than there are winners. So if you're the type, well, I shouldn't say if you're the type, but if you are following the herd and you're doing what everybody else is doing, you're probably not going to make money because everybody else, or at least most of them, do. To be a successful trend trader, it requires substantially deep pockets. And when I say substantial, I mean really deep. To put things in perspective, you've probably all heard of the turtle traders. You know, they made millions and millions of dollars trend trading. Anyone that's ever thought about trading commodities has probably run across a book or two discussing the experiment and everything. But the turtle traders, based on their risk parameters, they would have had to have approximately traded one E-mini S&P per $200,000 on deposit. I can't think of a single person that I know trading a single E-mini S&P in a $200,000 account. In fact, I know people that are trading a single E-mini S&P in a $1,000 account, or even a smaller account than that, day trading anyway. The overnight margin on an E-mini is $5,000. So for you to get yourself into a position that is required for trend trading to work, it might require that you put in $195,000 above and beyond the initial margin requirement. So just think about that for a minute. Not everybody can do that. Not everybody has nerves of steel, and we're going to take a look at an example of a trend trade and maybe the emotional roller coaster that it might be. It's not easy money. I know from a distance, if you're not trading and you don't have any skin in the game, you pull up a chart and you say, well, gold was going up. It would have been a cakewalk to buy gold and ride the trend and make a ton of money. But it's not that easy when you've got money on the line. Being a trend trader takes extraordinary patience and discipline, and not everybody has that. I know I don't. So is the trend really your friend? Well, trend traders are basically forfeiting a high win percentage and accepting the possibility of really big losses, and they're also risking giving back substantial profits for the prospects of a windfall winner. And every once in a while, when they catch a ride, they catch a big ride, and there's a lot of money to be made. But let me just point out what that means. Okay, you'll notice with this little blue arrow over here, a typical, and this is just a simplified example. Again, there are lots of different types of trend trading methods, and some of them maybe are better than others, but this would be just kind of the typical trend trading method. Back when crude oil was trading around 60 bucks last year in 2015, somebody might have gotten a false short signal on a crossover here. And this looks pretty harmless if you're just peeking at the chart, but the reality is somebody that would have gotten a signal here. Now keep in mind, one thing I really need to disclose before we go any further, trend trading methods generally have very deep stops, meaning that trend traders give the market a lot of room to breathe. So your risk per trade is large, but you have to have a large risk per trade to give the market enough breathing room to do what it needs to do, to catch the trend. So in this particular case, this person might have started making money initially, but eventually would have been proven to be a poor signal. And very rarely do trend trading methods go to a break-even stop. So if the market goes in their favor a little for a day or two, they generally won't go to break-even stop. They generally leave their stop, way up somewhere up here, and kind of let the market play out. So with that in mind, assuming that that's the case, somebody might have had 2 or 3 false signals before ever catching a ride. And in fact, this would have been possibly a false buy signal. So they would have been trying to go long here when the market collapsed. Assuming they were savvy enough to get out of that trade and get into the short, they probably wouldn't have done it till somewhere down here. Again, this seems relatively tame and harmless, but the reality is each of these false signals might have produced losses of $2,000 to $4,000 a piece. So already, before we even get to our 4th trade and catch a nice little ride, we might be in the hole, who knows, $6,000, $9,000, maybe even more. I don't know about you, but $9,000 per contract is pretty steep for me. Emotionally, I probably couldn't handle it, and not many people can. Imagine if you had three, let's just assume $3,000 losses, and you're down $9,000. Would you really take the fourth one? I'm not sure you would. I'm not sure most people would. But if you did, you might have caught a nice ride. And to put this move into perspective, if you've ever traded crude oil, just hypothetically assuming you got filled around 56 and you rode it all the way down, you could be up a good $14,000, $15,000 depending on fills. Now, obviously, that's real money, and that makes these $9,000 losses worth it. However, the thing about trend trading is, like I mentioned, they trail stops, but they trail them deep, meaning they almost always will give back a lot of the profit before getting out of the trade. Now, someone might say that, well, why wouldn't they just start tightening the stop? Well, honestly, they should, but a lot of trend traders simply don't. Their goal is to ride the trend until it ends, and if that's the goal, you keep a deep stop. But you could imagine in this situation, they would have given back $10,000 in 3 days. So suddenly, we're probably roughly breaking even, or you might be slightly ahead. And then once again, we get another false signal before catching a nice ride. The idea I'm trying to point out here is trend trading is not nearly as easy as it seems on the surface, and it's probably not as high a probability proposition as most people assume it to be. It is really difficult. It takes a lot of money, and it takes nerves of steel. If you don't have the emotions to trend trade, you're in trouble, because imagine being the trader that took the first 3 trades and lost 9,000 and then gave up. So again, I'm not trying to discourage everybody from trend trading. I just want to make sure that everybody understands just what we're talking about here. Okay, the question is swing trading a better strategy? Well, I mean, that's obviously up for debate. But in my opinion, for my personality, I think it is. Swing trading is basically the practice of identifying overbought and oversold markets and then trading against the trend. So this is basically doing exactly the opposite of what's natural and comfortable for most humans, for most people. It has been said that it's the equivalent of buying fear and selling greed. You've probably heard the famous Warren Buffett quote, "Be fearful when others are greedy and greedy when others are fearful." Well, that's exactly what swing trading is. Swing traders are trying to buy when others are panicking to sell, and they're trying to sell when others are excited to buy. Ironically, even though swing trading is going against the grain and going against what most traders are doing at the time, it actually comes with higher win percentages. Remember, I said most traders lose trading commodities. So it kind of makes sense. If you're doing the opposite of what most traders are doing, you might have a little bit of an edge. Not always, but generally speaking. Swing trading comes with smaller profit potential. That is true. A swing trader is never going to catch the big ride that a trend trader catches. But if a swing trader is making money on 60% of their trades, or maybe more, maybe a little less, but more than the 20 or 30% that a trend trader might be making, then perhaps it's worth it. One of the big drawbacks of swing trading is it's possible to sustain rather large losses in a runaway market. And let's take a look at a chart so you have an idea of what we're talking about here. So again, swing traders are basically selling when others are buying and vice versa. And in this particular chart, it's clear to see doing the opposite of what everybody else is doing would have worked rather well. And now, of course, I picked out an example that did work rather well, but I think you'll find if you pull up a chart of most commodities, they spend most of their time trading in a range, just like this. And they spend less time creating a new range. So in the long run, in most commodities, you're probably going to find that counter trend trading will work more than it doesn't. What you have to be careful with is when it doesn't work, you don't want to be caught with a massive bloody loss on your statement. Most of you probably realize this is gold, by the way, and gold is quite a bit higher now. So somebody that got caught on trying to sell into the upper end of the range. Let's assume that gold did, let's say it broke out of this trading range and ran into the 1450 area, which is a possibility. Somebody that didn't cut their losses in time might be suffering. But again, more often than not, the trading ranges and the overbought, oversold indicators, they work. Okay, another topic that we refer to in higher probability commodity trading is risk management. Due to the simplicity of placing a stop loss order for risk management, it's really the go-to method of preventing runaway losses. And with that said, due to the simplicity of trading futures, most commodity traders simply trade futures instead of exploring the option markets. And I personally think this is a mistake. For starters, I think the option market can provide traders with higher probabilities of success and slower trade in that it lowers basically the leverage on the position and the risk on the position. So whether you decide to trade futures as your primary speculation or options as your primary speculation, there are ways to manage risk with options. So for example, the problem with placing stop orders in futures is it's permanent. When you get stopped out, you're out of the market and you really have no chance of recovering your loss. Imagine, I'm going to use a pretty extreme example, but imagine being long an E-mini S&P during the flash crash or last August when the S&P dropped a couple hundred points in a couple of days and then came right back. The problem with stops is I can guarantee you there are people that were stopped out of their long E-mini S&Ps at massive, massive losses near the lows only to see the market recover without them. The beauty of using options to protect your futures position, and it could be long options or it could be short options, is that you have lasting power. That option will protect you regardless of how low the S&P goes. The S&P could go to zero. And don't get me wrong, you're going to be losing money, but your risk will be limited to what you paid for the option if you bought a put. And it can always recover. You're always in the game. So once it gets to that point, your option's protecting you and you're losing money, but it can't get any worse. It can only get better. Whereas if you were trading a futures contract and you placed a stop loss order, once you're out of the market, you have no way to recover. And I know that's probably the exact opposite of what most books and webinars and presentations will tell you. Most things that I read, they almost always say, always use stops. And I understand why. Sometimes you put a trade on and you go get a cup of coffee, and by the time you come back, you're sitting on a big loss. I mean, those sorts of things happen. So I completely understand why the assumption is that you should always have a stop loss in. I'm just saying, if you're the type of person that needs to have absolute risk and you want to know what your total risk is, the worst case scenario, maybe you should consider using the option market rather than a stop loss order. And in the book, we talk a lot about that. And this chart's just going to kind of give you a basic idea of why options might be a better choice for risk management than futures. The reality is most stop loss orders are hit, and they're almost always hit at inopportune times. In this example, you'll notice this is the NASDAQ, by the way. The NASDAQ continually tested resistance up here, and it finally broke through. So anybody that had a stop loss here actually did pretty good because the market went a lot higher. But the point is they probably didn't get back in. So they might have got stopped out here, or somebody that was giving the market a lot of room might end up getting stopped out near the highs, like a trend trader could have. Well, a trend trader wouldn't be short, but somebody with a deep stop might have been stopped out up here in the highs, and I'm judging by price action, I'm assuming that is exactly what happened, only to find the market come back without them, because they're sitting here, they locked in their loss, now they're out of the game, and the market recovers. This is probably a little better example. You can see somebody that might have placed a stop order right here. They're long the market, they place a sell stop, which makes sense. The market bottomed out here, it bottomed out here. That seems like a reasonable stop loss. However, what seems reasonable doesn't necessarily mean it works. Markets tend to seek stops, And if they're hit, and you're hit on the low, there's really nothing you can do about it. You can try chasing prices higher, but anybody that's ever been stopped out prematurely and has tried to get back in chasing prices higher knows it's kind of a no-win game because you're emotional at that point, you're revenge trading, and it rarely turns out well. Okay, now that we've discussed a few, well, scratched the surface of a few things that we discuss in the book, I'd like to just kind of answer a question that I get quite often. Why did you write higher probability commodity trading? Well, I got to tell you, it was quite the project. This is the latest book I've written. This is the 4th book I've written. It is the longest. It was the most work, but I do believe it's the best book I've ever written. And the reason I say best, I'm not bragging or anything. It's just there's so much information, and I think it's a lot of information that you probably won't find anywhere else. Not because I'm smarter than anyone else or I somehow have a magical 8-ball. It's just simply that I've been a broker for over a decade, and I have seen just about anything. I've seen every trading strategy under the sun. I've seen the good, the bad, and the ugly. And so from all these experiences, I've been able to accumulate different perspectives than most books are written from. And hopefully I can portray that in a way that helps readers apply these types of ideas and strategies to their own trading methods and hopefully give them better odds of trading success. This book is intended to be independent. In other words, if you haven't read any of my previous work, you should be able to pick up this book and read it from cover to cover and be fine. But it does build on educational material that I've created over the last decade. And if you are a beginner and you find that you're going through this book and it's a little too advanced for you in some topics, it might be worth checking out some of my previous books just to get a better refresher. But also, one of the primary things I wanted to do with this book is I wanted to articulate the commodity market analysis that I use when I'm featured on Jim Cramer's Mad Money. Jim uses my analysis on the show occasionally, sometimes once a month, sometimes more, sometimes less, just depending on what's going on in the commodity markets. But it's challenging to fit a lot of analysis in a small segment, and so hopefully with this book I can explain some of the details of what it is that we do and how we come to our conclusions.